It's a great pleasure to welcome to What's Next Marvin Nair, who is the Investment Solutions Executive at Old Mutual Corporate, to talk about a very, very important topic and thinking about your future and thinking about your retirement. Marvin, it's a great pleasure. Welcome to the show.
Thank you. Thank you very much, Aki. It's an absolute pleasure to be here. I'm very much a fan of what you're doing, so looking forward to the opportunity to engage.
You know, Michelle Acton recently joined me to unpack what we've learned since the introduction of that two-pot retirement system. It's incredible the impact that it's had on South African families, on South African business, you know, in the entire economy. I think it's been really positive in many respects. From your perspective, what's been the biggest lesson? What have you seen from your perspective?
Well, to be honest, Aki, it's quite an interesting experience, because the big lesson has been moving from theory to practice, which is something that you don't always get to engage with at this level. And what we've seen is that South Africans are actually engaging with the retirement savings a lot more than before. And it's absolutely something we want, right? People have often only started engaging in their late years, closer to retirement. And unfortunately, at that point, the levers you can pull to change your outcome are limited. You don't have as much time, don't have as much flexibility. But with this increased awareness that savings pots, withdrawals, and the two-pot system have brought along with them, people are actually engaging a lot more with the retirement savings, which is a massive positive. They're starting to think about the potential outcomes of what could happen in the future and potential ways they can optimize their life right now with I guess, a lot of the thinking around long-term goals, balancing that with, I guess, financial pressures that they experience right now. And that's really given us really valuable insight into people's behaviors right now in terms of the decisions they make, in the trade-offs they're trying to, I guess, optimize in this new two-pot system. So I think we're now really thinking about how members should behave and how we can also map that to, I guess, some of the retirement solutions we're creating around how they actually behave. So it's been a really, really insightful journey that we've been on, and thinking of how we can create a solution that meets people where they're at right now.
Yeah, it's absolutely fascinating. And I also get the sense that, you know, people have been, by and large, I'm not saying everyone, but people have been very responsible with how they handled that lump sum of money that they've received. It's gone back into the economy. People are reinvesting it into their homes, whatever the case may be. But one of the themes from Michelle's interview was that flexibility is now part of that retirement journey. And that's, for me, is a big shift. What has that changed the way that investment professionals think?
Absolutely, Aki. Absolutely. And that's a great question, because retirement investing had often been seen as this something you assume that people are just going to do the right thing, consistently save to, I guess, the best extent they can, and then access the money in retirement. You didn't really think about all the other variables along the way as much as you are essentially asked to think about it today. That's definitely not the case. The objective hasn't really changed, if we're honest, in terms of trying to optimize that retirement outcome. We definitely still want people to retire with enough money, but we're asking different questions now that there's greater accessibility in one pot, particularly the savings pot, but then also inaccessibility in the retirement pot. That is really changing the way we think about investment strategies, and especially coupling that together with people's behaviors. We now need to think about solutions that are appropriate across the stack, across what is, I guess, referred to as the vested pot, which is what you had on 1 September 2024, but then also going into the future about those retirement pots and savings pots, the often referred to as the inaccessible and accessible pots into the future. We need to try and see how we can get a solution that for those pots is giving you the most optimized outcomes, regardless of, I guess, the ups and downs everyone experiences, while also keeping them on track for retirement. It's a lot more variables to think of. And if I had to summarize it, though, we definitely not changing the destination. It's just how we think about the journey that's changed now.
Okay. That's so interesting. I find this whole retirement system and the two-pot system absolutely fascinating, how it has just evolved and how it's impacted South Africa. So what's the question? You know, I guess investment professionals are asking different questions. What are the questions that they're asking today that perhaps they might not have been asking 2 or 3 years ago? Because this whole situation is so unique.
Yeah, absolutely, Aki. And I think the biggest thing that we're really questioning right now is timing. Timing matters as much as the amount someone is, I guess, withdrawing from their savings pot. And the reason for that is that markets are dynamic. There's different cycles. We find ourselves at different stages in our lives, and that coincides with different stages of the market. More than before, investment professionals definitely have to think about when a withdrawal happens, are we optimizing the outcome for that investor? Is this the best possible answer we have for them while they're withdrawing to still protect that retirement outcome we want to have them optimize in the future? So if someone needs to access their retirement savings during a market downturn, the investments are actually sold at lower prices. If we just think about the typical stock market behavior, if you are trying to access your investment at a time of a market downturn, you're locking in a loss that even if markets recover later, unfortunately, the assets you had are not there anymore. They're not going to be to the same extent. They're not exposed to that recovery. So you cannot participate in it in the same manner as you would have had you not accessed that money. So that's really a component within what we broadly start looking at around sequence of return risk. And it's essentially talking about the timing of returns and the order in which you experience them, because the order matters. It really matters whether you experience a -10 at the same time as when you're trying to access, say, your savings pot withdrawal versus the 10% that'll come later that you can't participate in. And in reverse, it would have been great if the 10% happened first, you withdraw on your savings pot and the -10 only happened after. That is the type of risk we really need to think about and really need to try and manage investments relative to that. So while sequence of returns is not really a new risk and timing is not a new risk, it's really becoming more relevant because of the frequency of withdrawals, the ability to access more frequently through the savings pot. Now we really need to think about that through a member's working life and how we can help them, I guess, optimize the retirement outcome despite, I guess, some of the market volatility they might experience along the way.
Yeah, that's so interesting because I don't think most people would naturally think about timing, right? Can you give us an example of this timing? Because, we know we're human beings and timing is never predictable, right?
Absolutely. Absolutely. And I think anyone can stand around and try and tell you about their crystal ball and what they've seen, but they're going to get it wrong 100% of the time. No one perfectly knows the outcomes in the future. The best we can do is try and optimize what we have to deal with potential future outcomes, right? That's ultimately what we're trying to do. We're not trying to predict the future because we'll never get it right. But what we're trying to do is give you the best possible outcome despite what might happen in the future. So because the two-pot system is quite new, we don't really have, truthfully, decades of member data to analyze so that we can really tell you the historical market data that we can model to tell you what the potential outcome is going to be. But we did still want to try and test with whatever data we have. So what we did is we actually did a bit of modeling around a member's retirement journey just since around 2007, which is, I guess, when we had quite a bit of data for all of the potential investment vehicles you could use in retirement. We started from that date and we took it to March 2026 because something very interesting happened in March 2026. I'm sure a lot of people saw the headlines of all the stuff that was going on in the world at the time. But what really, really stood out for us is that it was an interesting data point. It was very intriguing because post 1 September 2024, there weren't many opportunities to observe the impact of a market downturn coupled with someone accessing their savings pot. Of course, it's happened along the way, and there was maybe little drawdowns here and there in terms of market experience. But what actually happened in March 2026 was a material drawdown in markets, right? You're looking at around 4-5% of market losses generated during that period. And of course, because of the Middle East conflict that took place at that point in time, it was escalating geopolitical tensions at that point, and that unfortunately did spill over into the markets. But what also happened at that point in time is we moved into a new tax year, we moved into a new tax here in South Africa, and people were once again given the opportunity to access the savings pot. And what it showed us is just the impact of someone withdrawing in that month relative to prior months was a lot more detrimental to their future outcome. We have a few different solutions that we make use of that can try and, I guess, as you spoke about in the beginning, smooth out the journey. We particularly have a solution that sits around trying to manage that particular volatility. And if you compare that type of solution relative to a typical balance fund, you end up in a far better situation because you don't lock in losses at the same time as a market drawdown. So what really happened at that point in time, you're looking at people being 7-8% worse off in 1 month because they've drawn down at the same point in time when the market has experienced essentially a downturn. And that's really, again, coming back to that sequence of return risk, where it's critical that the market almost plays into your hand when you're drawing down, and you don't really want to worry about that. And there are solutions to try, I guess, help with that. So the lesson isn't really that markets don't recover. They usually do. The lesson is more that we've really had to think about people having to sell investments during a downturn, and those investments not really benefiting from the recovery thereafter. And that's ultimately really why timing matters and why we've really had to place a key focus on it. And March 26 was a great example of that, or March 2026 was a great example of that, because members really was potentially in a very difficult financial position. Also for people who wouldn't usually draw down. There might be people in slightly higher income brackets now considering that drawdown just because of the different financial pressures they might have been facing. Fuel prices were increasing. Inflation was, of course, having a bit of a run at the same point in time. That ultimately put pressure on even more South Africans than before, and it became a critical point of data for us to consider.
Absolutely fascinating. And to your point, the markets do recover. I mean, we saw this at the beginning of COVID. If you remember, it went like this and then it recovered. 2026 went like this and it's recovered. And, historically we've seen it, but it's great that you at Old Mutual have got incredible insights and you understand this data, you understand how markets react to situations so you can plan better, right? Because if members can't control when life happens or what markets are doing, this is where the industry comes in, and your insight that you have is such an important, beacon to help people understand and guide them through those tricky waters.
Absolutely, Aki, and that's exactly the challenge, right? Is we need to try and find ways to use this information to give people the best possible outcome. The sequence of return risk, I guess I'm talking about, is, as I mentioned, is not new. But what's really changed is how we consider that in a two-pot world. And it's brought it to much sharper focus because withdrawing during a member's lifetime is now a part of reality, where someone would have previously, I guess, interacted with their retirement fund, either close to retirement or they would have potentially, unfortunately, if they were in an event of financial distress, maybe they got retrenched, they might have actually taken their money at that point in time. That is changing. The ability to do that is changing, and the accessibility through the savings pot is now a continuous reality where some people are, I guess, dipping in on a more frequent basis. But what we can do is, with that knowledge, we can then look at investment design and see what we can do to try and, I guess, improve outcomes, knowing where people are at, knowing that people are going to access more frequently. How can we meet them there? How can we give them a solution that gives them the best possible outcome, whether they access their money or not? So that is, I think, a very, very useful thing that has come out of this. I mean, our historical modeling really shows that investment approaches that are designed to reduce the impact of market volatility, especially during periods of withdrawal, can produce materially stronger long-term retirement outcomes. I mean, the lesson for us is really that as investment professionals, we need to think of this quite simply. Investment design that can help protect member outcomes when timing turns against them is actually what is really critical for us to think about now. It's not just about, I guess, that long-term goal and trying to optimize it as much as possible. It's also looking at, over the short term, how can we really help people navigate, I guess, turbulent market cycles, especially when the timing turns against them.
Yeah. So, I mean, my final question to you is that, like, you know what, people ask, you know, do you have any regrets? You know, if there's one regret that I have is not listening to the wise people in my 20s and 30s. And the wise people said to me, invest for your retirement. You know, think ahead, plan ahead. You know, put that money aside every single month. And you know, some people like myself, we leave it till we in our 40s, and then we have to, you know, we panic, you know, and you put extra and you kind of make up for that lost time. But I want to ask you, Marvin, what is your advice to young people today in their 20s and in their 30s to think ahead when they do retire one day, and you take into account the volatility that's in the world, you look at AI and you look at all the stuff that's happening around you. What advice do you give young people today in their 20s and 30s to plan ahead for their retirement one day?
Oh, it's a very loaded question, but a very important one to answer, because you really can make the difference to your retirement outcome now in those 20s and 30s, because the value of compound interest is absolutely, well, compound growth is absolutely unbelievable. And that is optimized over periods like this, when you have 30, 40 years of saving, right? So the best and I guess most to the book advice I can give people is discipline. Consistently try and save as much as you can over time. Try and save 15%. I mean, that's typically the golden number. People are talking about 15% of your income. Try and make sure that goes on a monthly basis towards your retirement savings. Try and stay the course, regardless of what goes on, all the noise around you. Try and absolutely invest for as long as possible without touching that money. We know there are realities along the way that can make that tough. And try and, I guess, be mindful of the potential impact, especially on your compounding if you access that money. And then on top of that, think about the investment solution you're investing in. Think about how it can potentially help you get the most optimal outcome. And what you really want is a solution that is going to protect you, especially close to retirement. What often happens is we think about that date in the future and we hope that, look, there's this great investment opportunity that's been doing well over the long term. But the truth be told, for the person who is retiring at that point, the solution is a very much needing to deliver over short-term periods as well. Let's think back to COVID-19, right? March 2020. I think you spoke very well about the V-shaped recovery. If we look back at what happened in March 2020, there was a significant drawdown by the end of that month. Your typical balance fund actually lost around 11%, which is absolutely massive and detrimental to someone who does not have time to recover. If someone retired, and often the rules are the rules, you're going to have to retire in March 2020. If unfortunately your birthday was around that time, you locked in a loss of 11%. Someone left with R1 million the month before you, the next person left with 890,000 Rand. So you need to think about a solution. It's absolutely massive, Aki, that potential outcome. Someone is walking away 10% better off the prior month. Think about a solution that can actually help make that a bit more equitable. And essentially that's the thinking behind a smooth bonus product. But the thing I also want to add is that post-retirement is also just as important. In the same way that people are essentially drawing down on a consistent basis now pre-retirement in the two-pot world, that consistent drawdown on a I guess annual basis, and in this case it's per tax year. But in post-retirement, you might end up in a living annuity, which is essentially a lump sum you invest, and over time it's meant to deliver growth for you, but at the same time you're drawing an income on it consistently, right? And that mimics essentially what's going to happen in the two-pot system, the way things are going right now. The key there, again, is absolutely sequence of return risk. We're thinking about it not only now in the two-pot system, but also definitely focusing on the post-retirement. What a lot of people do is try and be quite conservative in that space, maybe invest in your typical income funds, bonds and cash, just trying to make sure they manage some of that volatility. But the problem is they give away upside. You're going to get maybe a CPR plus 2, CPR plus 3 in those solutions. But if you get in a solution that can manage volatility while also giving you strong growth asset exposure in excess of that CPI plus 5, CPI plus 6%, what it does is it sets you up for growth while also managing that volatility when you're drawing down. If you're drawing down, you're simply not locking in as big losses if you manage to I guess, limit how deep those drawdowns are. So again, we look at how the solutions pre and post retirement can still give you a better outcome. Because remember, at retirement, it's not the end. It's just the start. It's the start of this money starting to have to work for you. And people can often miss that there's also a journey to be had there, and definitely thinking about that. So think about it in your 20s and 30s, be disciplined, but then look at a solution that can help you, I guess, get the best optimal outcome regardless of, I guess, market experience. But then don't stop there. Think about what the solution can do for you in retirement as well, so that you can optimize, I guess, the outcomes and your living standards into the future. That's my thinking, Aki.
Marvin Nair, Investment Solutions Executive at Old Mutual Corporate, thank you so much for joining us for this episode of What's Next. A very insightful and a very important conversation, thinking about your future and your retirement and planning ahead of time. Thank you for your time.